Good morning, everyone, and welcome. I call this meeting of the Ncua Board to order. The first item on our agenda is the Ncua's 2020 Annual Performance Plan. Staff presenting Eugene Sheard, Deputy Chief Financial Officer, Jim Holm, Director of Strategy and Budget, and Lindsay Courage, Management Analyst, Office of the Chief Financial Officer. Good morning, you all, and welcome.
Good morning, Chairman Hood, Board Member McWaters, and Board Member Harper.
Good morning.
Morning. Jim, Lindsay, and I are here to discuss the Ncua's 2020 Annual Performance Plan and ask the Board for its approval. This document is important to the Ncua because it, in conjunction with our strategic plan and our annual budget, provide a roadmap for the agency's workforce, our stakeholders, and interested parties about the specific strategies and initiatives that the Ncua will pursue in 2020, both in response to and in anticipation of changes in the financial industry and in credit unions. The Government Performance and Results Act provides specific direction to federal agencies regarding strategic planning and performance management. The Board approved the current Ncua strategic plan at its January 2018 board meeting. The strategic plan is the foundational document that sets a multi-year direction for the agency's actions and its prioritization of resources. The annual performance plans are guided by the strategic plan and provide greater specificity into the metrics and measures that the Ncua will track in a particular year towards achievement of the vision and goals in the strategic plan. The performance plan is updated annually in order to demonstrate progress reaching the Ncua strategic goals and to establish targets for agency performance in the current year. Jim Holm, the Ncua's Director for Strategic Planning and Budget, will next describe the process we use in developing the annual performance plan. And following Jim's remarks, Lindsay Courage, our lead analyst for performance management, will discuss some of the contents of the plan itself.
Good morning.
Good morning.
In our agency's continued effort to integrate planning and budgeting, we worked with offices throughout the Ncua to develop the 2020 Annual Performance Plan, currently with the 2020-2021 budget, which you reviewed and approved in December. Ncua offices were required to justify how funding requests for new and ongoing projects and for changes in staffing will help the Ncua achieve its strategic goals and objectives. As part of the budget process, we also asked offices to identify those specific performance indicators that will demonstrate the results of the budget's investments. As Eugene mentioned, this annual performance plan, in combination with the budget, shows how the Ncua will execute on its strategic plan in 2020. The Ncua's strategic plan contains 3 goals, which are 1, to ensure a safe and sound credit union system, 2, provide a regulatory framework that is transparent, efficient, and improves consumer access, and 3, maximize organizational performance to enable mission success. Our strategic plan is a framework for leadership's decisions about major programs, priorities, performance goals, and budgets. During development of the 2020 Annual Performance Plan, we worked to integrate offices' individual strategies and efforts that support the strategic plan. Here are 4 examples of the office's 2020 initiatives that we highlight in the Annual Performance Plan. The Ncua will release the new modern examination and risk identification tool in 2020, known as Merit, and will train the system's users. We will conduct an agency pilot around new examination procedures to evaluate critical cybersecurity controls during examinations. Third, the Ncua is continuing to streamline its field operations through initiatives such as the alternating examination pilot and the virtual examination program. And finally, the Ncua will conduct outreach efforts to promote the use and submission of the Voluntary Credit Union Diversity Self-Assessment, a tool for credit unions to evaluate their diversity programs and practices. Now let me turn to Lindsay Courage, who can give you a synopsis of the 2020 performance goals for the agency and the specific indicators proposed within the annual performance plan.
Thanks, Jim. Good morning.
Good morning.
As Eugene and Jim have highlighted, the annual performance plan is built on the foundation provided by the strategic plan and provides more detailed information about agency programs, such as measurable targets and milestones for each goal established in the strategic plan. The annual performance plan also states the actions and activities the NCUA will perform to accomplish its strategic goals, explains how the agency will monitor progress in relevant areas of its operations, and identifies priorities from among the performance goals. For 2020, the NCUA's 4 priority performance goals are: 1, to fully and efficiently execute the requirements of the agency's examination and supervision program. 2, to effectively identify and evaluate risk in complex credit union portfolios. 3, to promulgate efficient, targeted regulation tailored to offer meaningful relief without undermining safety and soundness. And 4, to implement secure, reliable, and innovative technology solutions. The CFO's office is responsible for measuring and reporting on progress implementing the strategies necessary to meet the agency's performance goals. Indicators in the annual performance plan include those related to measuring the percentage of credit union system assets in CAMEL Composite 4 and 5 rated credit unions, evaluating cybersecurity risks during credit union examinations, and releasing the merit system to NCUA examiners and state regulators. Although today's agenda item is for approval of the 2020 annual performance plan, I would like to remind everyone that NCUA also publishes a retrospective annual report. The annual report for 2019 will include a line-by-line update showing the NCUA's progress in each of the performance measures set for last year and discuss the reasons for any variance or change in performance trends over the past 12 months. We anticipate having the NCUA annual report published in March. The current and recent annual performance plans and annual reports, as well as the NCUA strategic plan, budgets, and financial statements can all be found on the ncua.gov website. Thank you for your time today. This concludes our presentation. We're happy to answer questions.
Great, thank you. And thank you all for your presentation on the NCUA performance plan. Regulation is vitally important in ensuring the safety and soundness of the credit union system. That is why I want to see a regulatory system that is effective and not excessive. The NCUA board has been working steadily to modernize our regulatory system. That means modifying, updating, and in some cases, eliminating regulations that no longer fit today's changing and dynamic financial system. We want to create a more responsive system that will encourage innovation, provide flexibility, and fulfill our primary mission of protecting the safety and soundness of the credit union system and the Share Insurance Fund. Our results for 2019 will be published in March in the NCUA's annual report, and our regulatory accomplishments will include such things as: 1, we were able to increase the threshold on appraisal requirements for commercial property. We were the first federal banking regulator to issue interim guidance on conducting business with the legal hemp industry. We adopted the Payday Alternative Loan 2 rule that offers an affordable solution to the market demand for short-term, small-dollar loans, and we expanded employment opportunities to those convicted of nonviolent convictions that have since paid their debt to society through the Second Chance Initiative. The 2020 annual performance plan before us today is about looking ahead. While I am pleased with our progress since becoming chairman, I believe that this plan sets forth performance goals for 2020 that, when met, will make for an even stronger NCUA and credit union system. Our work includes initiatives to help credit unions, within the bounds of safety and soundness, serve their members more effectively, including members of modest means and those in underserved areas. This is done through our chartering and field of membership functions and our technical assistance to low-income credit unions and minority depository institutions. In 2020, the NCUA will continue to develop initiatives that promote financial education and greater financial inclusion, especially for rural and underserved communities, people with disabilities, and others that have been unable to join the financial mainstream and have access to shared prosperity. The actions that the NCUA took in 2019 and our planned agenda for 2020 will strengthen our ability to adapt to the changes taking place in the industry. I now have just a few quick questions for all of you. First, how does the annual performance plan tie in to the supervisory guidance that the agency just issued?
Sure, thank you. So issuance of the supervisory priority letter in and of itself supports the annual performance plan, specifically strategic goal 1, which is to ensure a safe and sound credit union system. Specifically, there's goals and initiatives that we outline in the annual performance plan under goal 1, which include providing high quality and efficient supervision, targeting exams where most needed, and effectively identifying and evaluating risk. And so by communicating the exam areas of focus in the supervisory priority letter, it contributes to us achieving those goals and objectives.
Very well, thank you. How does the annual performance plan tie into the budget that we recently approved?
Yes, sir, I can answer that question for you. So the budget and the annual performance plan are both rooted in our agency's strategic plan. The budget and the APP were developed simultaneously over the summer and into the fall. And as we worked with offices on the budget, we asked them to justify their resource requests with explanations of the results that each office intended to achieve or plan to achieve with the additional funding that they requested. So, sort of in summary, the budget is the means to achieve the results that we want to see help us make progress toward our strategic goals. And the annual performance plan is really a roadmap for how we expect to accomplish those goals and hold ourselves as an agency accountable for the investments that we've made through the budget.
Great. Well, you mentioned holding the agency accountable, but what are some of the actual steps that we really do to make sure that all of the stakeholders that are engaged with the implementation of the plan are held accountable?
So I would point to several mechanisms we use to establish accountability. First, the plan itself has 51 specific measures and milestones. Each one of those 51 is assigned a particular lead office within the NCUA. And so that establishes accountability for each of the specific measures in the plan itself. As we proceed through the year, there is a process by which the lead offices report into the CFO's office at least quarterly and assess their performance against those particular measures and milestones. And that is compiled into a report that we'll send up to the NCUA board throughout the year. As you know, we go through a mid-session budget process.
I'm familiar.
Yep. As a part of that budget process, we'll take into account, as we consider potential adjustments in resources, performance against the performance targets established for the year. I'd also point out that each executive within the agency is a part of our performance management system, has a performance element that's results-driven, and it's through that results-driven element of the performance plans that executives can be held accountable for the measures, milestones that are in the plan itself. And the last I'd point to, as you mentioned and Lindsay alluded to, we do a retrospective report at the end of the year, which is a public-facing document, which provides transparency and accountability into how we did against the previous year's performance plan.
Great. Well, again, thank you for all your hard work. I know from the briefings that I had with you all, I was really impressed with the level of detail, especially just the work that went into all of those 51 items. So thank you very much. I have no further questions. Board Member Harper.
Thank you, Chairman Hood. And Eugene, Jim, Lindsay, it's been a while. It's good to see all of you here at the table. Eugene, you in particular know how important the annual performance plan is to me. I strongly believe that if you are going to measure performance, you need to have metrics and you need to focus the attention of the agency, and certainly the annual performance plan does just that. And I, for one, read the quarterly updates quite regularly and ask questions about particularly if we're behind on certain issues. What I appreciate about this year's annual performance plan is that it does work to address all 4 of my priorities, including capital and liquidity. There are provisions focused on that. There are also provisions focused on cybersecurity, such as the asset exams, working to starting to get down to credit unions of 100 million or more, checking out what's happening there. Consumer financial protection provisions are in here, as well as provisions focused on underserved communities, and especially to support low-income credit unions, minority depository institutions, and small credit unions. So I'm very pleased. I'm particularly pleased to see a new metric in this year's performance plan that takes a look at quality assurance controls for how we are conducting our limited consumer financial protection reviews under our supervisory priorities for the year. I think it's really important to be focused on that issue. We have to remember at the end of the day, it's humans who are behind each of these transactions and what's happening here. I would be remiss today if I didn't recognize that we have some members of the Taxi Workers Medallion Alliance that are here in the room, and they were certainly affected. And when I'm making decisions on the board, I want to make sure that we understand the human impact, and looking at consumer financial protection is certainly part of that human impact. I will be supporting this proposal. Thank you.
Thank you. Board Member McWaters.
Thank you, Mr. Chairman. I have no comments or questions. Thank you.
Very well. Is there a motion?
Yes, I move that the board approve the 2020 annual performance plan as attached to the board action memorandum.
Is there a second to the motion?
A second, sorry.
There is a sufficient second. All in favor say aye.
Aye.
Aye. All opposed say nay. The ayes have it, and let the record show the motion passed 3-0. The second item on our agenda today, thank you again, everyone. The second item on our agenda is a board briefing on civil monetary penalty statutory inflation adjustment. Staff presenting Ian Marina, Associate General Counsel, and Jira Bose, Staff Attorney, Office of General Counsel. Welcome, both of you.
Good morning.
Good morning.
We're here to brief the board on the final rule to adjust the NCUA civil monetary penalties, or CMPs, for inflation. This is an annual rulemaking which is specifically required by federal statute. The board approved the final rule by a notation vote in order to meet the legal deadline. Gira will now provide an overview of the final rule and offer some additional details.
Good morning, Chairman. Good morning, members of the board. In 2015, Congress enacted the Civil Monetary Penalty Inflation Adjustment Improvement Act. And pursuant to that statute, federal agencies, including the NCUA, are required to adjust maximum levels of the civil monetary penalties under their jurisdiction on an annual basis to account for inflation. The requirement means that we have to submit our adjusted maximums to the Federal Register by January 15th of each year. The statute also requires the Office of Management and Budget to issue guidance to the agencies to provide the calculations that agencies will then put on their the penalties under their jurisdiction, and that includes providing agencies with an inflation multiplier. This is a mandatory requirement. Agencies do not have the discretion not to undertake this annual requirement. The only exception would be if an agency had already adjusted a particular penalty in the preceding 12 months pursuant to some other authority in an amount greater than what is required under this 2015 statute. That's not the case here. NCUA didn't make any such adjustments, and so we're bound to follow this requirement. The time frame for getting this done is quite tight. We have to publish in the Federal Register by January 15th. The OMB guidance doesn't come out until mid-December, and so Congress contemplated that agencies would bypass the usual Administrative Procedure Act process and move straight to a final rule. That's why the board approved this rule by notation vote on January 7th, and it was published in the Federal Register on January 14th. We'd be happy to answer any of your questions.
Great. Well, again, thank you both for your presentation and for joining us, but more importantly, for just the alacrity in which you were able to get this done for us. Congress has mandated that all federal agencies have the authority to impose civil monetary penalties, and they must adjust the maximum levels of these penalties to account for inflation. The adjustments must be made on an annual basis and published, as you mentioned, in the Federal Register by January 15th of each year. As part of the process, the Office of Management and Budget must issue guidance to agencies on implementing the adjustment for inflation. That guidance must be issued by, I guess, December 15th, essentially, giving the agencies 1 month to finalize this rule. Because the OMB guidance was not issued until after our December board meeting, and the rule had to be published prior to today's meeting, I would like to thank my fellow board members for their prompt review and approval of this rule. The board unanimously approved the rule by notation vote on January 7th. The purpose of today's briefing is to brief the public and our stakeholders on this board's action. I just have one question. And that is, does the rule mean that the agency will now be imposing the maximum penalty each time there's a violation?
Thank you, Chairman. No, it doesn't mean that at all. The statute only requires that we update the maximums to maintain the deterrent effect of these penalties, but agencies maintain their discretion in assessing penalties. And actually, pursuant to the Federal Credit Union Act, the agency is required to consider mitigating factors before making assessments of penalties for things such as the size of the credit union or the egregiousness of the violation. And just by way of example, in the first 2 quarters of 2019, the agency issued approximately 13 civil monetary penalties for an average penalty amount of $385, so well below the maximum.
Very well. I have no further questions. Board Member Harper.
Thank you, Chairman Hood, and thank you both for your presentation here today, Ian and Gira. I think it's very important that we provide transparency to the public about what our actions are. You actually anticipated my question about the average size of the penalty, so I have no questions, and I will support. I already supported it.
Thank you for re-supporting it. Board Member McWaters.
Thank you, Mr. Chairman. I have no questions or comments.
Great. Well, thank you all.
Thank you.
Thank you.
The third item on our agenda today is Proposed Rule Part 708A, Subpart D, Credit Union Combination Transactions. Staff presenting Kevin Taninga, Associate General Counsel, and Elizabeth Warwick, Senior Staff Attorney, Office of the General Counsel. Welcome.
Thank you. Good morning.
Good morning.
Elizabeth and I are here to present for you for your consideration a procedural rule on the acquisition of assets and liabilities from institutions other than credit unions. Elizabeth is going to briefly summarize the material portions of the proposal, and then we'll be happy to address any questions that you have. I'll turn it over to Elizabeth now.
Thank you, Kevin. Good morning, Chairman Hood, Board Member McWaters, Board Member Harper. The proposed rule before you today adds a new Subpart D to Part 708A to address transactions between federally insured credit unions and institutions that are not credit unions. As you all know, Section 205 of the Federal Credit Union Act specifically authorizes these transactions, but also requires the NCUA's prior approval for them. Part 708A and 708B of NCUA's regulations currently address all of the other types of transactions authorized by Section 205, and these rules set forth the details about the NCUA's process for evaluating the transaction. The proposed rule, which we're adding in as part of Part 708A, is an effort to bring similar clarity to the NCUA's expectations about transactions between credit unions and other types of institutions. The proposed rule does not provide new authorities for federally insured credit unions. Rather, it simply spells out the NCUA's requirements and processes for considering transactions that are authorized in the FCU Act. Just as the proposed rule does not create new authorities, in practice it should not create an additional burden on credit unions proposing these kinds of transactions. The new Subpart D simply lists the various elements and actions that are necessary both for the credit unions proposing these transactions and the NCUA's required evaluation of them. To that end, Section 708A-403 of the proposed rule itemizes the components of a complete application package. The Office of Examination Insurance convened a task force last year comprised of the regional office staff who processed these applications, and many of the items now in that list came from recommendations from the task force. The proposal also ensures that credit union directors are fulfilling their fiduciary duties by having directors who vote in favor of any particular transaction certify that they received full and complete information about it from credit union management, and that they do not have any conflicts of interest. NCUA regulations require a board vote in credit union to credit union mergers, as well as the other types of transactions authorized under Section 205. So it seems logical that these kinds of transactions would also have a board vote, but by making it the requirement explicit, we're making this part of the regulation parallel to the others in section that implement Section 205. Additionally, the proposed rule recites the statutory factors that the NCUA must consider in evaluating these transactions. And finally, it also seeks to improve clarity around federal credit union membership requirements and has cross-references for Section 741.8. Thank you, and I'd be happy to answer any questions.
Great. Again, I want to thank you for your hard work on this. I know we've had multiple briefings. I know this is an area that's been generating a great deal of attention, and not just OGC that's worked with this, but I also like to commend the work and efforts of our E&I staff as well, who all worked to bring today's proposed rule to fruition. The number of credit union acquisitions of bank assets and certain liabilities is small relative to any standard. As we continue to see the evolution in the marketplace, one of my priorities as chairman is to be forward-thinking. Credit unions as well as banks have asked for clarity on this process. That is why I've brought this rulemaking before the board today to consider the issue and to add even more transparency to the process. Since 2012, credit unions have acquired roughly 30 bank assets and assumed certain liabilities. We should recognize that these acquisitions are occurring at a time when options for financial services are dwindling in far too many of our local communities, especially in rural areas. Credit union acquisitions of banks may be particularly beneficial for underserved and rural communities, which have seen a severe contraction in access to financial services over the last decade as financial institutions close branches. When communities lose access to financial services providers, it's like cutting off the oxygen to the local economy. Small businesses suffer, jobs are lost, and consumers, especially low-income households, are more likely to turn to less carefully regulated predatory lenders. If a credit union acquiring a local bank allows for continued access to financial services when those services might otherwise have been lost, then that's an outcome we should encourage. It is my concern that in instances where credit unions aren't allowed to make these types of transactions, it leaves a potential void and vulnerability in underserved, low to moderate income, and rural areas. When a federal credit union acquires a bank, NCA requires a two-step process to establish the membership status of the former bank's customers. First, the federal credit union must confirm that the bank customers are within the federal credit union's field of membership. Secondly, the former bank's customers must become full members of the federal credit union. For state chartered credit unions, the state regulatory agency determines field of membership eligibility and credit union membership. In considering the rule before us today, the NCUA is taking steps to add even more clarity to the acquisition process. I want to highlight a few provisions of the proposed rule that demonstrate how it meets the efficient, transparent regulatory framework of the NCUA's strategic plan and all that it envisions. First, the rule provides more information about what the NCUA needs in order to fulfill our statutory mandate to approve or disapprove these transactions. Second, the rule lists the circumstances under which deposits qualify for share insurance through the National Credit Union Share Insurance Fund and explain the process for making customers of other types of financial institutions members of federal credit unions. Third, the proposed rule also amends Section 741.8 to include cross-references so that it is clear which NCUA rules apply to which transactions. Again, these are not new requirements, but continue the NCUA's efforts to make our regulation as clear and transparent as possible, something that is a top priority under my chairmanship. Finally, the proposed rule incorporates the statutory factors the Federal Credit Union Act requires the NCUA to consider in approving or denying proposed transactions. Restating these factors in the regulation increases stakeholder awareness of them. The transactions the proposed rule addresses represent our free and open market system at work, and the Federal Credit Union Act specifically authorizes them. With NCUA oversight, I believe the proposed rule provides some much-needed clarity about that oversight process without imposing undue burdens. I now have a few questions. Media descriptions of these transactions often describe them as a credit union buying a bank. I'm concerned that this description misses the mark because credit unions do not end up owning a bank because credit unions do not own bank stock, for example. Can you describe how these transactions actually occur? I don't know which one of you wishes to take that.
Sure, Mr. Chairman. Yes, the phrase "the credit union buying a bank" is certainly a catchy tagline, but you are absolutely correct that the reality is a bit more nuanced. As you point out, credit unions can't own banks, they can't be bank holding companies, and they can't own bank stock. So what's happening in these transactions is that the credit union is assuming the liabilities of and or purchasing the assets of the bank. If all the bank's liabilities and assets are involved, such that the bank won't exist after the transaction, on the bank side of the transaction, the stock is redeemed and paid out as an earlier step in the transaction. So the credit union does not end up with the bank stock or the bank charter, but rather just the assets and liabilities of the former bank.
Thank you for that clarification. If a credit union acquires a bank, can you describe the process of how the NCUA ensures a bank customer will be able to comport with the credit union's field of membership?
Yes, Mr. Chairman, you did a really good job of summarizing that in your statement. And it's sort of two parts. For the field of membership for federal credit unions, the NCUA would want an explanation from the credit union of how those bank customers fit into the federal credit union's field of membership. That's what 708A, Section 405A of the rule describes. In that process, the federal credit union would work with the regional office, the Office of Credit Union Resources and Expansion, to document how each customer fits into the FOM. Of course, as you said, for state charter credit unions, that's all determined by the state regulator.
Great. And then another area that I'd like to, just for the record, to amplify, it's not just NCUA acting solely on these transactions. Could you talk about a little about what the FDIC's role is in this process?
Yes, the FDIC has an instruction where they say that the bank, the Federal Deposit Insurance Act requires their review of every credit union merger transaction. According to the instructions in the manual, the case manager has to consult with their legal staff and review disclosures to bank customers and make sure they comply with their requirements as well.
Thank you. So again, these transactions are not arbitrary or capricious, and they must have the imprimatur of both the FDIC and the NCUA in moving them forward.
Exactly.
Great, thank you. I have no further questions. Board Member Harper.
Thank you. Elizabeth and Kevin, it's great to see you up here at the table. Thank you for your presentation and your hard work on this issue. Because the proposed rule before us today aims to create clear rules of the road with some appropriate guardrails for credit unions seeking to acquire the assets of institutions other than credit unions, I will support this proposal. While the frequency of credit union to bank deals is increasing, is still relatively small in number, especially compared to the overall level of bank-to-bank mergers, which are typically more in the total of about 250 a year, as I understand. There has been a modest uptick in these transactions in recent years. This increase in deals has led some to suggest that credit unions are, quote, abandoning their founding mission in the name of expansion and risky lending. These notions are misguided at best and misleading at worst, because we all know that it takes two to tango. In fact, data on these deals suggests that banks whose assets are acquired by credit unions tend to be smaller institutions, often with limited growth prospects. Additionally, credit unions tend to enter into these deals to take advantage of economies of scale, provide, as the chairman noted, services in underserved communities, deepen existing market footprints, enter new regions, or obtain needed expertise in certain products and services like commercial lending. When done consistent with statutory requirements and following the principles of safety and soundness, these transactions support the credit union mission to meet the credit and saving needs of consumers, including those of modest means. Over the years, the NCUA has routinely reviewed these deals to ensure that the acquiring credit unions comply with the agency's regulations and that these deals do not threaten the safety and soundness of the credit union. In conducting these reviews, each regional office has used its own due diligence procedures, and the Office of General Counsel over time has developed expertise in these reviews. In fact, Elizabeth, I think you have reviewed every single one of them since we started?
Some parts of them.
There you go. With this experience now underneath our belts, the proposal we are considering brings together the best aspects of those procedures. By doing so, it increases transparency around these deals, and it lays out basic requirements and guardrails for these transactions. One of the most important guardrails in this proposed rule would make sure that conflicts of interest are avoided. As I requested, as part of the Board of Directors certification for the application package, the proposal would require a statement that each director signing the certification does not have a pecuniary or a personal interest in the transaction. This provision aims to prevent self-dealing. It would not only be a black eye on the credit union system, but it would also fly in the face of the credit union mission if a member of the Board of Directors stood to personally or financially benefit from these transactions. Another important guardrail is the provision that requires credit unions to develop a plan for the disposal of impermissible assets. Because these potentially problematic assets could pose undue risk to federally insured credit unions and potentially the share insurance fund, ultimately, they must be addressed up front. Finally, for the good of the credit union system and its members, I intend to continue the dialogue I started in September about strengthening the NCUA's consumer compliance program. As the credit union system evolves, so must the NCUA. Many of the banks that are part of these deals are supervised by, for consumer compliance by the Federal Deposit Insurance Corporation. That agency has a consumer compliance program that is by far more robust than the NCUA's program. The FDIC conducts regular consumer compliance reviews and assigns the bank a separate compliance rating outside of the CAMEL supervision process. That separate review of the compliance management system and the composite rating does not occur in credit unions. Would-be new members of acquiring credit unions deserve to have the same level of consumer financial protection at their new financial institution as they had at their bank. For that reason, I will keep pushing the NCUA to step up and make sure that consumers receive strong financial protection. Before I close, I do have one more question for you, Elizabeth. I guess I already asked you one. When the credit union converts to a bank or to private share insurance, the NCUA requires the members to receive certain disclosures about the change and the effects that it has on their deposit insurance. In contrast, our proposed rule on credit union combinations with non-credit unions is primarily focused on safety and soundness reviews and application procedures. Am I correct in noting, and you started to talk about this with the chairman, but I'd hope you would speak a little bit more. Am I correct in noting that the bank regulator has procedures to alert consumers about the change in ownership and deposit insurance?
Yes, Board Member Harper, you're correct, and I'll expand a bit more. This regulation, because it addresses what happens on the credit union side, of course, doesn't address what happens on the bank side. But yes, the Bank Merger Act and Federal Deposit Insurance Act require a process when there's a change in deposit insurance. And the FDIC definitely looks at this, even if they're going to an accusive insured deposit. For them, it is a change. And it triggers all their change procedures and warnings. And what the manual says is when it's a credit union, they have some forms for this, but when it's a credit union, there's some special language they develop. And I will say that one transaction that's going on right now, I know the bank's lawyers and the credit union's lawyers are all working closely with the FDIC and us to make sure that the customers have what the FDIC believes is notice that fulfills their statutory requirements as well.
I very much appreciate your expansion on that issue, and thank you for your answer. As I stated earlier, I will support this proposed rule, and I look forward to reviewing the public comments when received.
I do too. Great, thank you. Board Member McWaters.
Thank you, Mr. Chairman. Based upon my experience as an M&A corporate and tax attorney and CPA for approaching 40 years, it is clear to me that market forces and arm's length negotiations have driven the recent spate of mergers between credit unions and community banks. Interestingly, some argue that credit unions are using their tax-exempt status as a means to gobble up community banks like a game of financial Pac-Man. Those who advocate for this position contend that credit unions and community banks were created on a level statutory and regulatory playing field, except that credit unions were inexplicably given an unfair tax-exempt status. As a former tax attorney, I find this perspective inconsistent with the law. Let's take a look at the Federal Credit Union Act. Banks, by contrast with credit unions, may issue both equity and debt capital in public offerings and private placements. For regulatory capital purposes, and community banks may often avoid corporate-level income taxation by making a taxpayer-subsidized S-corporation election under the Internal Revenue Code. Under the Federal Credit Union Act, however, credit union authority to raise capital for both the risk-based net worth ratio and the net worth ratio test is materially limited. First, under the Federal Credit Union Act, credit unions are limited to issuing debt as opposed to equity instruments. Stated another way, the Federal Credit Union Act does not authorize credit unions to issue equity capital in a private placement or a public offering. Second, even where the Federal Credit Union Act provides the authority to issue debt, the permissibility of counting that debt towards the risk-based net worth ratio or the net worth ratio is statutorily limited to complex credit unions, low-income credit unions, and new credit unions. Under current NCUA regulation, non-low-income credit unions may only build regulatory capital through the retention of earnings. Credit unions accordingly are placed at a distinct competitive disadvantage to community banks, with the latter's ability to raise common stock and other equity and debt capital in public offerings and private placements. The Federal Credit Union Act also places limits on credit union growth through the field of membership, member business lending, investment authority, and other statutory restrictions. These limitations explain why relatively few banks elect to merge with a credit union or convert to a credit union charter, even though credit unions are not subject to federal corporate income taxation. That is, the quid pro quo for the credit union income tax exemption imposes meaningful statutory restrictions on the ability of credit unions to raise regulatory capital and conduct their business operations in a manner parallel to and competitive with that of banks. Specifically, banks, particularly those community banks that avoid corporate level income taxation by making a taxpayer subsidized S corporation election under the Internal Revenue Code, are understandably loath to voluntarily accept, whether through a market-driven arm's-length merger with a credit union or otherwise, any of the four following competitive disadvantages to and statutory constraints on their business models and operations in return for a credit union charter. 1, relinquish their ability to raise common stock and other equity and debt capital under the Federal Credit Union Act capital restrictions. 2, materially limit their customer base under the Federal Credit Union field of membership restrictions. 3, restrict their commercial and corporate lending activity and the fees generated thereby under the Federal Credit Union member business lending restrictions. And 4, narrow their profitable investment activity under the Federal Credit Union Act investment authority restrictions. In contrast, credit unions in the NCUA must operate strictly within, among others, these 4 statutory limitations in a fully accountable and transparent manner. Simply put, if the credit union tax exemption was of such value to community banks relative to the statutorily enacted competitive advantages granted to community banks and denied to credit unions, many more community banks would have merged with a credit union or converted to credit union status a long time ago. Ironically to some, I suppose, based upon an objective analysis of the applicable governing statutes and regulations, one could argue that the overall most favorable organizational structure for a community financial institution is that of an S corporation electing community bank. After all, those institutions avoid corporate level income taxation, as well as the equity and debt capital, field of membership, member business lending, investment authority, and other statutory limitations applicable to credit unions. In any event, we should remain mindful that it is not intellectually possible to address the credit union tax exemption and the tax policy underlying that exemption in a fair-minded and objective manner without also acknowledging the competitive restraints placed on credit unions in under the Federal Credit Union Act relative to those placed on community banks under their governing statutes, as well as the ability of community banks to avoid corporate level income taxation by making a taxpayer subsidized S corporation election under the Internal Revenue Code. After representing the so-called money center or too big to fail banks for much of my legal career, teaching tax law at a law school and a business school, and serving as a member of the TARP Congressional Oversight Panel and the NCUA Board, it is apparent to me that credit unions and community banks are often materially different financial institutions with specifically tailored in targeted business models, operations, and ambitions. The overwhelming majority of these institutions, whether credit unions or community banks, are growing, thriving, and prospering, and have, from all indications based upon the facts before us today, little interest in changing the status of their organizational charter. If on occasion market forces and arm's length negotiations indicate that a merger or other business combination between a credit union and a community bank makes economic sense, the proposed rules before us this morning will assist both parties in negotiating, documenting, and closing their transaction in a fully accountable and transparent manner. In closing, I must admit that the endless Hatfield-McCoy carping between credit unions and community banks has grown tiresome and of little purpose, except perhaps as a marketing tool for some. Instead, these financial institutions should acknowledge that their future viability is not so much threatened by the other, but will rest on how they respond to the economic and operational challenges presented by, among other matters, the following issues. 1, the branch network of the largest money center banks. 2, app-based and other remote and electronic means of providing financial services. 3, fintech and other non-traditional financial firms. 4, cybersecurity and other emerging threats. 5, the continuing innovation in the delivery of financial services that will evolve in unexpected and surprising ways. And 6, the maintenance of sufficient regulatory liquidity and capital and the avoidance of lending and investment over concentration. As a safety and soundness prudential regulator, this is what keeps me up at night. I am far less concerned that a credit union and a community bank may determine that it is in their mutual economic interest to merge together, regardless of whether the credit union or the community bank continues as the surviving financial institution. These transactions reflect market forces and are negotiated in an arm's length manner. The Ncua and other financial regulators should respect the independent, market-driven business decisions of the interested parties unless safety and soundness, consumer protection, and related matters indicate to the contrary. Thank you. I have no questions.
Thank you, and I couldn't agree with you more. At the end of the day, it's the consumer having a choice as to how his or her family will be served. Is it going to be a bank or a credit union? If we do not have regulated entities serving these vulnerable communities, it leaves many of them vulnerable to pernicious payday lenders. So thank you all for your hard work on this. Is there a motion?
I move that the board approve Part 708A, Subpart D of the Ncua Rules and Regulations for a 60-day comment period as attached to the board action memorandum.
Is there a second to the motion?
Second.
There is a sufficient second. All in favor say aye.
Aye.
All opposed say nay. The ayes have it, and let the record show the motion pass 3-0. And I do look forward to reading the comments. Thank you all. The fourth item on our agenda today is a proposed rule, parts 701, 702, 709, and 741, subordinated debt. Staff presenting Larry Fazio, Director, Office of Examination and Insurance, Tom Fay, Director, Capital Markets, Julie Decker, Risk Officer, and Justin Anderson, Senior Staff Attorney, Office of General Counsel. Welcome, all of you.
Good morning. We're here to present for your approval a Notice of Proposed Rulemaking, or NPR, addressing subordinated debt authority for natural person credit unions. You'll notice that this is both a substantial and intricate proposal with the goal of ensuring that stakeholders understand both its core provisions and the underlying policy considerations that influenced it. We designed this proposal with the goal of maintaining the original intent for low-income designated credit unions, or like-Us, to accept secondary capital while also expanding authority to meet the emerging needs of other non-like-Us that may desire to utilize subordinated debt to augment their capital for RBC, or risk-based capital compliance purposes. For terminology purposes, we will collectively refer to all previously used descriptions of this activity, such as secondary capital, alternative capital, and supplemental capital. We'll collectively refer to that herein as subordinated debt. To provide context, we'll briefly highlight the following. 1, the Ncua's history with subordinated debt or secondary capital. Our extensive research and consultation efforts throughout the multi-year process of developing this rule, some key legal and financial considerations, and the major provisions of the proposed rule. Because of its complexity and because it introduces both regulatory flexibility and new prudential requirements, we are recommending the proposed rule be published with a 120-day comment period. Slide 2 provides some historical context for credit union capital standards, including secondary capital for low-income designated credit unions, or LICUs. Starting in 1996, the NCUA board first authorized, through regulation, low-income designated federally insured credit unions to accept uninsured secondary capital under their statutory authority to borrow from any source and to count it for regulatory capital purposes. It was shortly thereafter, in 1998, as part of the Credit Union Membership Access Act, that Congress instituted a system of prompt corrective action for federally insured credit unions that's based on a credit union's level of net worth. We sometimes refer to those as the capital standards, regulatory capital standards. The Act specifically defined net worth, amongst other things, to include secondary capital issued by a LICU, provided that the secondary capital is uninsured and subordinate to all other claims against the LICU, including the claims of creditors, shareholders, and of course the share insurance fund. In 2006, the board amended the secondary capital authority to require regulatory pre-approval before they would issue such instruments. And then in 2015, the board finalized the risk-based capital rule and began contemplating offering complex credit unions the authority to use secondary capital, what we call subordinated debt, to comply with risk-based capital purposes. In 2016, we also did a briefing for the NCUA board at a public board meeting on such instruments, subordinated debt and regulatory capital treatment. And then in 2017, the board proposed and issued an advance notice of proposed rulemaking to solicit comments from stakeholders that would inform how we might actually develop a rule. Then again in 2018, December, the board included in its regulatory reform agenda doing a proposed rule on subordinated debt as a Tier 1 goal. And then in September of 2019, we issued a letter to credit unions and a supervisory letter that addressed evaluating secondary capital plans vis-a-vis the application process. And that was shared with all federally insured credit unions. And today we're here to present the culmination of all of that with this proposed rule. So slide 3, just in the way of background also, we have trends here of secondary capital and low-income credit unions. The blue line represents the trend in the number of credit unions that have the low-income designation. You can see a significant uptick since 2011, now with over 2,600 credit unions being designated as low-income, about half of all credit unions at this point. The green bars represent the dollar amount of outstanding secondary capital that have been issued by LICUs, and the orange line at the bottom represents the number of LICUs that have issued outstanding secondary capital. Currently, in 2019, we're 68 credit unions, LICUs that have outstanding capital for a total of about $300 million across the system. So not a big uptick in the number of credit unions using this authority, but we have seen some growth in the dollar amount involved. On slide 4. So in the next few slides, we'll recap some of the critical steps and research staff have undertaken to address this broad and complex range of foundational issues related to subordinated debt. We took a number of steps to ensure we had sufficiently covered the factors that bear upon this authority. These steps cover the following. First, we consulted with outside counsel on securities laws issues, tax implications, and debt treatment. Second, we reviewed banking regulations, in particular the OCC's regulatory framework for banks to issue subordinated debt. We also reviewed all existing secondary capital agreements. So those 68 credit unions that have outstanding capital, we looked at all of their documentation and related information. We also did a comprehensive review of the NCUA's regulations to make sure we approach this holistically, that we look for other areas of the regs that would need to be cohered based on this proposal. And we also conducted various outreach to stakeholders and other market participants to help inform this proposed rule. So at this point, I'm going to hand it over to Justin, and he's going to talk about some of the top considerations, in particular securities law issues and our key objectives for this proposed rule.
Thank you, Larry. On slide 5, our research culminated in the top considerations that you see on the slide that we focused on in developing this proposed rule. We'll refer to each one of these throughout our presentation, but the point I want to make here is that this proposed rule was designed to ensure that subordinated debt issuances are done within a federal credit union's statutory authority to borrow from any source. This is authority that federal credit unions currently have, and is the authority under which like-us currently issue secondary capital. Turning to slide 6, I'll provide a brief overview of some of the securities laws implications and considerations for credit unions. While credit unions would be issuing subordinated debt under their borrowing authority, issuances of subordinated debt notes would be considered securities under federal securities laws and may be considered securities under state securities laws. This is currently true of secondary capital issuances. While credit unions, like banks, are likely exempt from federal registration requirements, credit unions that issue subordinated debt will still be subject to the broad anti-fraud provisions of the Securities Exchange Act of 1934. Generally, the anti-fraud provisions prohibit the use of manipulative or deceptive devices in connection with the purchase or sale of securities. In addition, a credit union may be found to have violated the anti-fraud provisions if it engages in fraud, deceit, or provides a false or misleading statement or omission in the offering, sale, or purchase of securities. Relevant case laws suggest that the type and amount of disclosures an issuer must provide depends on a multitude of factors. It is incumbent upon a credit union issuing subordinated debt to ensure it has provided full and accurate disclosures in connection with the issuance or sale of any subordinated debt note. I reiterate that these are not new requirements for credit unions currently issuing secondary capital, but we did take this opportunity to provide transparency and clarity around what the Ncua views to be the minimum disclosures and offering materials necessary for credit unions issuing subordinated debt. This clarity and transparency will aid credit unions in creating disclosures and offering materials required for the issuance of subordinated debt and provide investors the protections and disclosures they are accustomed to receiving from banks and other entities issuing subordinated debt. The requirements in this NPR are similar to those imposed by the OCC on banks that issue subordinated debt. It is important to note that the information required in this NPR is a minimum level and is not intended to be an all-encompassing list for the purposes of complying with all applicable securities laws. In addition to the anti-fraud provisions, issuing credit unions must also have policies and procedures to address ongoing disclosures and communications with investors and potential broker-dealer registration issues. Under this proposed rule, issuing credit unions must develop such policies in consultation with qualified counsel, with the expertise in the area of federal and state securities laws and debt transactions similar to those described within the proposed rule. Finally, an issuing credit union must also consider the need for additional director and officer liability insurance coverage based on its issuance of subordinated debt notes. Turning to slide 7, with all the information that Larry and I have discussed so far as context, we drafted the proposed rule with 4 key objectives in mind. First, we wanted to incorporate the lessons learned from overseeing the current secondary capital framework. We also wanted to consider the stakeholder feedback from the 2017 ANPR and the input from our outside counsel. Second, we wanted to extend responsible regulatory relief where possible. For example, we're proposing to expand credit unions' authority to issue subordinated debt to include new credit unions and complex credit unions, and also those credit unions that anticipate becoming a low-income credit union or a non-low-income complex credit union within 24 months of issuing subordinated debt. Third, we made necessary revisions and clarifications to the current secondary capital regulation. We recognized the current regulation needed to be updated to improve its clarity surrounding rule requirements and the process for NCUA's approval of secondary capital plans. We're also building in some additional relief for low-income credit unions that are currently doing this. And finally, we sought to consolidate all capital-related regulations for natural person credit unions into a single place in Part 702. This will allow readers to more easily reference and understand the NCUA's capital-related regulations. Our intent was to develop a clear and transparent regulation for all credit unions eligible to issue subordinated debt. With this proposal, credit unions should have a clear understanding in the requirements and process for the authority and issuance of subordinated debt. We'll expand on this point in a little bit. In summary, we aim to reorganize and consolidate the related rules, strike the right balance between prudential regulations and regulatory relief in providing credit unions additional tools to manage their capital in a safe and sound manner. We also sought to provide additional clarity on the application requirements, note disclosures, and investor protections that provide a more clear and transparent framework for both the issuer and investor. I will now hand it over to Julie, who will discuss the proposed expanded authority and a high-level view of the proposed reorganized regulations.
Thank you, Justin. One of the more important aspects of this proposed rule is providing additional credit unions the authority to issue subordinated debt. Like yous have had the authority to accept secondary capital since 1996 and will continue to be eligible to issue subordinated debt under this proposed rule. In addition to like yous, this proposal expands the eligibility to issue subordinated debt to non-like you complex credit unions, but only to count toward the risk-based capital requirement, because the statute does not define net worth in a way that allows any credit union other than a like you to count such debt issuance in their net worth ratio calculation. The proposal also expands eligibility to non-like you new credit unions. First, the term new credit union means an insured credit union that has been in operation for less than 10 years and has not more than $10 million in total assets. While a new non-like you credit union would not be eligible for regulatory capital treatment, there is relief from prompt corrective action if the new credit union meets specific conditions related to the subordinated debt. And in evaluating the new credit union's revised business plan, outstanding subordinated debt or grandfathered secondary capital would be considered. Lastly, the proposal expands eligibility to credit unions that anticipate becoming a like you or non-like you complex credit union within 24 months of issuing subordinated debt. I just have a couple more comments on this. In moving forward with this proposal, the current secondary capital issuance outstanding by like yous will be referred to as grandfathered secondary capital at the effective date of a final subordinated debt rule, maintaining its original functionality until either it matures or reaches 20 years, whichever is sooner. Second, all new debt issuances occurring from the effective date of a final rule would be considered subordinated debt, while any existing issuance approved under the current secondary capital rule would be considered grandfathered secondary capital. This chart further illustrates the expanded eligibility and highlights how many credit unions are eligible under the current authority and how it would expand under this proposal. The capital treatment for net worth and risk-based capital appears on the right side of the slide. As I mentioned, like yous, as shown in the green shaded area, have had this authority since 1996 and can count it towards their net worth and risk-based capital requirement, as indicated by the check marks on the right side of the table. With the proposed rule, a number of credit unions will become eligible. See the new eligible on the left side of the chart in the orange shaded section, which shows the rule would provide an additional 285 credit unions the authority to issue subordinated debt, but only count it towards their future risk-based capital standards scheduled to take effect in January 2022 if they are non-like you and complex. The remaining 2,409 credit unions that are not a like you, complex credit union, or new credit union would not be eligible to issue subordinated debt for regulatory capital treatment purposes unless they can show that they will become a like you or complex credit union within 24 months of issuing subordinated debt. For example, we know there are 40 credit unions with total assets between 450 and 500 million, of which 21 are non-like yous. And so the number of eligible credit unions may increase over time. As previously mentioned, several regulations need to be updated to make the regulatory framework consistent. We also wanted to better organize the content. We considered the proposed rule not only from an issuing credit union's perspective, but also from the perspective of those credit unions that may invest in such issuances. First, we created a new section in Part 701 to address loans by a federal credit union to another credit union. This limit will also apply to FSCUs through changes made to Part 741. This new section also includes the statutory limits for credit unions lending to other credit unions, as well as new limits on investing in the subordinated debt of other credit unions. Second, we removed the secondary capital regulation from Section 701(34). We moved these to new Subpart D to house all capital-related regulations in one part. Third, we updated the borrowing rule in Section 701(38) to clarify that federal credit unions can borrow from any source. This rule currently only addresses borrowings from natural persons. For clarity, we felt it was important to mirror this section off the language in the Federal Credit Union Act and to cover all borrowings. Fourth, we created new Subpart D in Part 702, which houses the regulations related to subordinated debt. Fifth, we updated the payout priorities in Part 709 to reflect that subordinated debt and grandfathered secondary capital will be included as the last payout priority when a natural person federally insured credit union is liquidated. Lastly, we made changes to Part 741 to make Subpart D to Part 702 and Section 701(25) applicable to FSCUs. It is important to note that FSCUs may issue subordinated debt only if permitted to do so under state law. I will now hand it over to Tom, who will provide an overview of the rule changes and the NCUA resource implications.
Thank you, Julie. I'll provide an overview of the notable items in the proposed rule grouped into three categories. Number one, regulatory relief or new authority items. Two, retained clarifications and cohering changes. And three, proposed new requirements. I just have a couple of comments before we get into the first category. This proposal includes a number of new and revised rules that not only add prudential standards, but significantly clarify our requirements to issue subordinated debt. Revisions to rules will not only impact the current secondary capital rule, but many others as well. Some changes will benefit credit unions. Other proposed changes will clarify or cohere the NCUA requirements. And lastly, there will be new provisions. We've also supplemented these slides with an appendix that cross-references the three categories to their respective rule sections. With that, starting with regulatory relief or new authority on slide 12. We've already covered number one on the expanded eligibility to issue subordinated debt, which would add approximately 285 credit unions to the eligibility. For the second item, the proposed rule expands the potential pool of eligible investors in subordinated debt from the current institutional investors, defined as non-natural persons, members, and non-members in the secondary capital rule, to accredited investors, but with restrictions on certain persons affiliated with the issuing credit union. The accreditor investor requirement is more widely accepted standard, consistent with banking regulations, and appropriate given the risks involved in investing in securities. This will also play into some of the requirements with regards to disclosures and investor protections. The third item simplifies the application process because it allows a credit union to apply for multiple or discrete subordinated debt issuances as part of a single application, which may be more convenient in meeting the credit union goals, while also eliminating the prospect of multiple application reviews required by the NCUA. The fourth item on repayment of sub-debt, the proposal expands the credit union authority to prepay, in whole or in part, any portion of the subordinated debt, provided the note allows for that feature. This expands on their current authority, which only allows for prepayment of the portion that no longer counts as regulatory capital. This will provide credit unions with some added flexibility when managing their outstanding subordinated debt. For item number 5, on mergers, currently the continuing credit union may only keep an outstanding secondary capital acquired through a merger if it's a like-you. This proposed rule would allow the continuing credit union, regardless of its like-you status, the option to keep or repay any subordinated debt acquired through the merger, if permitted and by the terms of the note. And for item number 6 on safe harbors, the proposal provides new safe harbors for repudiation and interest payments. This will benefit both the credit union and potential investors by enhancing marketability and liquidity without sacrificing safety and soundness. For example, on interest payments, the proposed rule prohibits interest payments on subordinated debt for a critically undercapitalized credit union compared to the current discretionary approach. This approach aligns with banking law and would provide more enhanced certainty for investors. This is an example of one of the development objectives we set out in balancing market realities and the safety and soundness of the credit union industry. Moving to slide 13, which lists some of the key retained provisions or items where we've added clarification and items where we've made coherent rule changes. For the first item, as noted previously, we're revising the current borrowing rule to clarify that federal credit unions may borrow from any source, not just from natural persons. This is the change that coheres the borrowing permissibility with the Federal Credit Union Act. This change supports the legal authority to issue subordinated debt and provides clarity for investors. For item number 2, we are significantly clarifying the pre-approval requirements for both issuance and prepayment. These clarifications are consistent with the lessons learned from the current secondary capital rule and with the supervisory letter we issued in September 2019 on evaluating secondary capital plans. The trend of larger and more complex secondary capital plan applications in recent years highlighted the need for greater transparency in the proposed rule, both for the NCUA's regulatory expectations as well as for issuer disclosures and compliance with securities laws. We believe that this will increase the efficiency of the application process and make it easier for eligible credit unions to determine whether they would meet the approval standards for such authority. This specificity in this rule will help credit unions when preparing their applications. Item number 3 on regulatory capital treatment, we've maintained a basic framework and subordinated debt would be counted toward regulatory capital to make it clear and more accurate. Item number 4 on payout priorities. No changes to the current rule other than the activity under the label of subordinated debt would be added to the list of last priority for payout upon liquidation. And item number 5 in this proposal will be applicable to state chartered credit unions. So lastly, on slide 14, and for the new provisions or requirements of this proposed rule. First, we've added a requirement that subordinated debt must have a maximum maturity of 20 years. This provision, combined with others, is intended to ensure the instrument is properly characterized as debt, not equity. The minimum 5-year maturity was retained from the current secondary capital rule. Second, on the subordinated debt note itself, the proposed rule expands on the requirements, restrictions, negative covenants, default covenants, and lastly includes a proposed minimum denomination of $100,000 in certain circumstances or depending on the classification of the accredited investor. Most, if not all, of these additions align with the banking regulations and provide a more effective framework for subordinated debt. Third, and an important one, the proposal prohibits a credit union from being both an issuer of subordinated debt and an investor in another credit union's subordinated debt. This requirement would eliminate the exchange of subordinated debt instruments that result in an artificial inflation of net worth in the industry. There are some exceptions in the case of a merger or an acquisition. Item number 4 on the expanded requirements for disclosures in both offering documents and in the subordinated debt note. The proposed rule also adds an investor protection provision that requires an issuing credit union to deliver offering documents both to NCUA and in some cases will require NCUA approval, and to also potential investors. While the proposed rule expands on the current disclosure requirements, we believe the net benefit to credit unions and investors will be a positive. The proposed disclosure requirements may improve demand, result in better pricing, and reduce liability for credit unions. Item number 5. We've added new rules and limits on how much credit unions can loan to other credit unions, which will include subordinated debt instruments. The aggregate limit on all loans to other credit unions, including subordinated debt, already set forth in the Credit Union Act, is 25% of paid-in and unimpaired capital and surplus. We believe adding this to the regulation will make it easier for credit unions to understand and follow the rules for loans between credit unions. We've also are proposing a new single borrower limit of 15% of net worth that will limit how much a credit union can lend to another credit union. For subordinated debt loans, we're proposing an aggregate limit of the lesser of 25% of net worth or the amount of net worth above 7% of total assets on the total investment amount of subordinated debt a credit union can have. The proposed rule also includes requirements on the lending credit union to be well capitalized and generally not have any outstanding issuances of subordinated debt. And finally, we're prohibiting the payment of principal and interest on subordinated debt as a mandatory action upon prompt corrective action when a credit union is critically undercapitalized. Currently, it is a discretionary action and will remain so for the grandfather secondary capital. We made this change because we think it will add clarity and take the subjectivity out of our supervisory actions, thus ensuring everyone receives equal treatment for all credit unions. This presentation covered most, if not all, of the major items in the proposed rule, but we urge stakeholders to thoroughly read the proposal, and we look forward to the comments. One last matter before we conclude our presentation. There are, of course, resource implications. Based on the volume and complexity of the additional work associated with this proposed rule, we estimate the need for 2 additional legal staff with specialized expertise. In addition, we expect the agency would need to retain outside counsel to bolster internal resources and expertise. Given the trends over the past 4 or 5 years, we estimate that the volume of new applications, including the expanded eligibility of 285 credit unions, may be somewhere between 20 and 40 applications per year. While this does not represent a significant increase in applications, we expect a shift from like-you issuances to complex credit union issuances, which may be more complicated and may have more securities law considerations. This, coupled with potential larger amounts like those we've experienced in recent applications, will require additional resources. These resources are necessary to maintain adequate staff with the requisite expertise to handle matters related to securities law, subordinated debt offering documents, and asset securitization undertaken by credit unions. The estimated annual costs for these resources will approximately be $1 million. This estimate is based on the proposed rule, and the ultimate resource needs will depend on the final rule. In closing, we believe this proposed rule will provide responsible regulatory relief, improve the prudential framework for subordinated debt, and better organizes the rules related to subordinated debt. As Larry mentioned, we recommend a 120-day comment period. This concludes our prepared remarks. We'll be glad to answer any questions you may have.
Great. Well, thank you all for your presentation this morning. I appreciate the hard work and the considerable time and effort each of you and the rest of the team put into formulating the proposed rule for this very, very complex subject. Many low-income designated credit unions or LICUs and other financial institutions have a record of prudently using subordinated debt to increase regulatory capital levels to protect against future losses. Of the credit unions we oversee now as an agency, about half are low-income designated. Congress provided federal credit unions with the authority to borrow from any source. Federal credit unions borrowing in the form of subordinated debt is squarely within the statutory authority provided under the law. I support giving complex credit unions the authority to prudently use subordinated debt as an additional tool to comply with risk-based capital requirements, and newly chartered credit unions the ability to use this tool to get up and running. This expanded authority has the potential to currently provide up to 285 credit unions with greater flexibility to augment their capital planning strategies and to support their operations by adding another funding tool. While the 285 may not seem like a large impact to the number of credit unions, the complex credit union component will almost double the number of eligible credit unions that may utilize this authority. However, let me be clear, subordinated debt is not a panacea. It can be expensive and introduce new or different risk, but risk is not an inherently bad thing, but it must be managed and risk must also be mitigated. In addition, it's also important to ensure the subordinated debt tools properly function to protect the National Credit Union Share Insurance Fund. In order for a financial instrument to be considered regulatory capital for prompt corrective action purposes, NCUA must consider the instrument's degree of permanence, capacity to absorb losses while maintaining as an ongoing concern, and flexibility associated with principal and interest payments. Thus, the proposed rule contains various requirements to ensure the subordinated debt will be available to, once again, to protect the National Credit Union Share Insurance Fund, and that it also does not create incentives to engage in unsafe and unsound activities, and also preserves the cooperative governance structure of credit unions. It is essential the NCUA have prudential safeguards and a sound supervisory framework for subordinated debt. It is equally important to have strong investor protections, in particular with respect to suitability requirements and disclosures. I am pleased to have in this proposal provisions that not only address the sell side, but also the buy side. In addition to ensuring appropriate safeguards and investor protections, this proposed rule represents a good faith effort to identify areas where we can provide responsible regulatory relief for low-income designated credit unions, and to provide elements that will support the marketability of subordinated debt. One more important note about this proposal is that it will not change how LIQ can benefit from subordinated debt for both net worth and risk-based capital, if complex. The staff approached this rule holistically, identifying various related regulations that needed updating and addressing credit unions lending to other credit unions, including in the form of subordinated debt. Staff also considered how the state supervisory authorities will work with NCUA during the approval process. This complex rule may seem daunting at first glance, but most of what's been included is an attempt to be more explicit to increase clarity and transparency for existing expectations and requirements. It is also a significantly improved approach to organizing the related regulatory requirements, which should make it easier for credit unions to find and understand the relevant requirements. Given the length and complexity of this proposal, I support the recommendation to provide a longer public comment period of 120 days as compared to the typical 60-day comment period for most proposed rules. As Lucy Ito of NASCUS noted in her letter to the board on January 17th, and I quote, "A 120-day comment period is warranted to allow SSAs and all stakeholders the opportunity to fully contemplate the complexity of the subordinated debt concept and its related issues," end quote. To that end, I look forward to the feedback we will be receiving from our stakeholders. I now have a few questions for all of you around the table. First, when the board delayed the RBC rule to January 2022, I said the board would be looking at a number of tools, including subordinated debt, and how it would be integrated into the NCUA's capital standards during this delay. Larry, this may be best targeted to you. Can you please explain how this proposed rule would benefit a credit union that would be impacted by the risk-based capital rule in January of 2022?
Just by way of reminder, credit unions that are complex are defined as those with 500 million or more in total assets. And so those are the credits that are subject to the new risk-based capital standard when it goes into effect on January of 2022. So when we think about those credit unions, we're giving them, or would be giving them, a new tool to include as regulatory capital for purposes of meeting that standard. And to be well capitalized under that standard, they have to have a risk-based capital ratio, which is a ratio of qualifying capital in the numerator to risk-weighted assets in the denominator. That ratio has to be 10% or greater to be well capitalized. And so this gives them a tool to improve the numerator and thus improve the ratio. Just for context, there are currently 5 credit unions that are estimated to be below 10%, 5 out of the 574 complex range that are estimated to be below 10%, and another 10 or so that are between 10 and 11%. So they're above 10, but they're on the margin. And so those 15 in particular might have a real interest in using this new tool to help manage their compliance with risk-based capital and maintain a well-capitalized status.
Great. In general, how can a de novo or newly chartered credit union take advantage of this tool in practice?
A newly chartered credit union? I'm sorry. Well, obviously, a newly chartered credit union will have the ability to issue subordinated debt under this rule. While they may not be bound by risk-based capital requirements, we will consider their business plan and in terms of how they incorporate their sub-debt as part of their strategic planning going forward. So it gives them the opportunity to have it.
That's good to know. Last week, I gave a speech here in the DC area, and someone during the Q&A session asked me if this proposed rule would allow credit unions to leverage up or even allow credit unions to use subordinated debt to, going back to our earlier board topic, acquire banks. Can one of you answer these questions around them using this tool to acquire banks and lever it up?
That's a good question. If you look at our proposal, even if you start with our current regulatory or current reg, obviously the credit union is required to provide us with a plan in terms of how they're going to use sub-debt. We don't essentially mandate the strategic intent of what a credit union does with its capital. However, even with our proposed plan, there would be a binding constraint, let's say for a non-LICU complex, given they would not be able to use it for net worth, right? So essentially they could lever up, but there's going to be a binding constraint. Right? At some point, you're going to have net worth calculation issues if it's too fast or if it's too aggressive. So there are some, what I call backstops in our proposal.
Great, thank you. And with this proposal, just even from your presentation this morning, I know we're looking at some new terminology. The nomenclature is going to be changing with this rule. Can you reiterate the difference between the terms grandfathered secondary capital, and subordinated debt?
Chairman, I'll be happy to answer that question. You're absolutely right. We're throwing around a lot of new terms this morning. Secondary capital is what we currently have, and that is what LICUs currently are issuing. It's also the language that is used in the Federal Credit Union Act. Going forward, secondary capital and everything issued by complex credit unions, new credit unions, will be under the umbrella term of subordinated debt. With respect to grandfathered secondary capital, that's a term that's going to refer to any secondary capital that's issued before a final subordinated debt rule.
Great, thank you. Staff has assured me that the proposed rule has the necessary prudential safeguards to keep subordinated debt activities appropriate and safe for issuing credit unions. What are the key safety and soundness safeguards?
I'll answer that. Thank you, Chairman. Obviously, the underpinning of this whole proposal is safety and soundness, and obviously right sizing to what I would call current standards for securities law and issuance of securities. We've had the opportunity, given the history of this project, we've had the opportunity to bring forward improvements not only from the ANPR but previous to the ANPR, the current challenges today with our current reg. And really listening to stakeholders. So if you put all of those things together, it culminates into what I would call much more increased transparency. While this may be voluminous in its size, I would urge stakeholders to take a read because we went out of our way to be extremely transparent when we're proposing changes or new requirements. Prudential new standards, additional note disclosures, offering documents, all of these, just to mention a few.
Great, thank you. And this question I'm about to ask really relates to the process. The proposed rule would allow a credit union that anticipates becoming a LIQ or a non-complex credit union within 24 months of an issuance to issue subordinated debt within certain parameters. When such a credit union issues subordinated debt, would it count as regulatory capital right away or immediately, or would it have to wait until it achieves its LIQ or complex credit union status?
Chairman, I'll answer that question. They would have to wait until they achieve one of the two eligibility criteria, either becoming a LIQ or becoming complex. So while they may issue it 24 months before they anticipate reaching one of those goals, it would not count as regulatory capital until they actually hit that bar.
Great.
And I'd just like to add a clarification that they still have to apply too, so that it makes them eligible to apply. Part of that application will have to be demonstrating the projections that show they're going to, within 24 months, meet one of those two, either become complex, cross the 500 million asset threshold, or become a low-income designated credit union, meet those standards that are in 70134. So that would be part of the application process. If we got comfortable with that, we would approve them to do it. Then they can actually do a deal in the market within that time period.
And I would admire.
And it's in anticipation of having that capital in place so that when they become subject to RBC, they've got it.
And regarding CURE, I know CURE plays a pivotal role in terms of approving whether or not a credit union becomes a LIQ. And there are some instances where they are already able to do through the monitoring of the call report data, they can sometimes let a credit union know that they've become a LIQ even without them applying. So I just would note that that is something that's happening, I hear, in some instances. On first examination, it could appear that extending authority to issue subordinated debt to an additional 285 credit unions is somewhat limited. Can you talk to that and describe more how the proposed rule would help credit unions?
Sure, I can answer that. This proposal, there's several different ways that the proposal is actually going to help credit unions. I'm going to touch upon some of the more significant. First, as we already discussed, the expanded eligibility for complex credit unions that are not LIQs. This is going to increase eligible complex credit unions by approximately 50%, and it provides them a tool in managing their RBC. Additionally, we're expanding the investor base from just institutional investors to also include individual investors. However, they must be accredited investors in order to invest. We're also adding efficiencies for both the NCUA and the credit unions by allowing the credit unions to apply for and receive approval for multiple discrete issuances at once, instead of having to submit an application for each one. The proposal also expands a credit union's ability to prepay all or part of the subordinated debt prior to maturity if the note allows and with NCUA approval. Currently, they can only prepay the amount that does not count as net worth. So that gives credit unions some flexibility in managing their subordinated debt issuances. And finally, we also previously mentioned this, the proposal provides for some new safe harbors for both repudiation and interest payments. So this benefits both the credit union and potential investors, as it enhances the marketability and liquidity, and it also does not sacrifice safety and soundness while providing that.
Great, thank you. And this proposed rule, you all, if implemented, it is really going to require a lot of expertise, both within the industry and also even here within NCUA. And Tom, I believe you spoke to this in one of your slides. In fact, you estimate that the additional staff and outside counsel would be necessary to support this proposal. Could you go back again and maybe talk about specifically in terms of what is the specific expertise we're looking to augment here at NCUA and what functions will need to be performed?
Thank you, Chairman, for the question. When you go through this rule, you'll notice that there's a significant, there are significant sections in the proposed rule around note disclosures. That alone is a complicated and requisite expertise we would be looking for. Secondly, is the topic of securities law is complicated, and again, very the requisite expertise that we would need. Offering documents and the whole process around that approval process. And lastly is that, with the advent of asset securitization, which is really a close cousin to this, we would ask for those same resources to capture that as well.
Great. And again, I just want to thank you all this morning for your thoughtful answers and careful preparation for today. In summary, y'all, I believe that this proposed rule will provide responsible regulatory relief without posing undue risk to the National Credit Union Share Insurance Fund. I'll be supporting this because I think it's the approach that we need for our credit unions to have additional sources of capital and also to better serve their member owners. I have no further questions. Board Member Harper.
Thank you, Mr. Chairman. And Julie, Tom, Larry, and Justin, it's great to see you at the table. Julie, is this your maiden voyage at the board table?
Yes, it is.
Congratulations. You
Thank
did
you.
a great job. And thank you all for your informative presentation on this much anticipated and long awaited proposed rule. In my view, capital is king. Clarifying the ability of certain credit unions to issue subordinated debt will better protect federally insured credit unions, their members, and taxpayers from losses to the Share Insurance Fund. A well-structured regulatory system of subordinated debt also has the potential to expand access to financial services for underserved communities. Overall, the comprehensive proposed rule before us strikes a good balance. In my view, you all, staff, have done a very good job of constructing a workable and appropriate regulatory structure that will serve low-income, complex, and new credit unions well. In short, the proposal resulting from your hard work deserves our approval today so that the industry stakeholders and other interested parties may now offer their comments on these matters. With this proposed rule, we would create an overarching framework that would govern the subordinated debt issued by low-income credit unions, complex credit unions, new credit unions, and as you pointed out, aspiring credit unions that anticipate becoming complex or low income within 24 months of issuing the subordinated debt. For nearly 25 years, low-income credit unions have prudently used secondary capital, a form of subordinated debt incorporated within the proposed rule, as you talked about, Larry, to increase regulatory capital levels to protect against future losses and serve as a foundation for strategic initiatives and growth. These funds have served as a valuable resource to some low-income credit unions, enabling them to provide much-needed lending and other member services to underserved communities. Therefore, in expanding the use of subordinated debt within the credit union system, my first guiding principle was to ensure that, as Hippocrates, the father of early medicine, said, "First, do no harm." We need to heed that advice here. Consistent with the law, this proposal would preserve the access of low-income credit unions to secondary capital. Despite our considerable study, I nevertheless recognize that there may be unintended consequences resulting from this proposal. I therefore invite those low-income credit unions that have previously issued secondary capital to review and comment on the proposed rule. If we need to refine the proposal to better serve and preserve access to secondary capital for low-income credit unions, I am very open to considering those changes, so long as they are consistent with the Federal Credit Union Act, securities law, and other statutory requirements. In reviewing the proposed rule, another principle guided my thinking: the need to preserve the mutual, cooperative, one-person, one-vote structure of the credit union system. The introduction of funds into complex credit unions from parties from non-low-income credit union, complex credit unions, from parties outside of the credit union system, has the potential to undermine the basis for the federal tax exemption. Accordingly, the proposal before us would appropriately limit that outside funding to debt. By limiting the type of instrument to debt, we are protecting against the erosion of the mutual structure of the credit union system. Purchasers of the debt will lack voting rights and ownership in the issuing credit union. Moreover, the provisions in the proposed rule that would prohibit negative covenants ensure that investors in subordinated debt cannot interfere in the operation of the credit union or impose conditions that would affect the safety and soundness of the credit union or the NCUA's authority as a regulator and insurer. In reviewing this proposal, I hope that commenters will share their views on the need to preserve the credit union's cooperative structure and provide their thoughts on whether we need to modify the proposal to better protect the foundation of the cooperative system. One final issue was at the top of my mind when reviewing this proposal: the need to protect the investors in subordinated debt. This proposal would expand who can purchase subordinated debt from certain institutions to a broader group of investors, including natural persons who meet certain tests. And you were speaking about that earlier, Tom. Subordinated debt has real risk attached to it. In the best case, investors can expect a steady stream of income for a period of time. In the worst case, investors may lose their entire investment. I am concerned that investors, like the elderly retiree, are protected. As such, the disclosures that would be provided with any issued subordinated debt need to be transparent, accurate, and verifiable. They also need to be absolutely clear that the subordinated debt is not federally insured. In my view, the investor disclosures contained in this proposed rule are strong, but I recognize that we may be able to do better. In this regard, I hope that stakeholders and investor advocates will provide their thoughts about whether we need to further strengthen these written notices. Additionally, given the lack of a fiduciary duty owed by broker-dealers to investors, I'm interested in whether we might need to adopt additional sales safeguards to protect natural persons who invest in subordinated debt. There are several other aspects of this proposed rule that I like and which are good public policy. For example, I like that the proposal would prevent the creation of inflated capital, whereby two credit unions issued that issued and sold subordinated debt to each other. Said another way, you spoke of it as artificial capital. I think of it as a capital mirage, and this rule would help to prevent that. In preventing a credit union that issues subordinated debt from purchasing the subordinated debt of other credit unions, the proposal would also protect against loss transmission that could occur if one credit union fails, leading to a domino effect whereby other credit unions in the chain of transactions fail. We know far too well from the corporate credit union crisis that the downstream effects of a failure at one institution have the potential to magnify and grow if not properly abated in advance through sound regulatory policy. This rule works to accomplish that proposed rule. Additionally, in terms of the review and approval process by the Ncua, I like that this proposed rule would extend the time horizon of submitted financial statements from 2 years to 5 years. I also like that this proposal would preserve the ability of the Ncua to ask for additional information and documents when needed to assess the viability of the overall transaction. This reservation of authority is appropriate. Finally, I appreciate the conflicts of interest rules contained in this proposed rule. The proposal would prevent senior management and board members and their immediate families from purchasing the subordinated debt of the credit union at which they work or volunteer. The proposal would also codify a prohibition of the payment of direct or indirect compensation in the form of commissions, bonuses, or similar payments to any employee of the issuing credit union or a credit union service organization that assists in the marketing and sale of the issuing credit union subordinated debt. These are important limitations to include in this proposed rulemaking. Before I close my remarks, I do have several questions for staff. First, several respondents to the advance notice of proposed rulemaking stated that the Federal Credit Union Act does not permit credit unions to issue supplemental capital. It is important, therefore, to review this threshold legal question today. Justin, Tom, I think you also spoke a little bit to this. Would you walk us through the NCUA's legal authority to issue a rule permitting complex non-low-income credit unions that are complex to issue subordinated debt?
Sure, I'd be happy to walk you through that. So federal credit unions currently have the authority to borrow from any source. So in that regard, this is not a new authority. One of our guiding principles in designing this rule was to make sure that this stayed squarely in the debt space. Every time we looked at the rule, we looked at it through that lens to ensure that this stayed as a borrowing, because that is a federal credit union's authority, is to borrow from any source. With respect to state charters, they will still need to look for state law for the ability to issue subordinated debt. This rule does not provide independent authority for FSCUs to issue subordinated debt. But if under state law, FSCU is permitted to issue such instruments, then a FSCU would have to properly comply with our regulation. What is new in this proposal is the board counting such instruments toward the risk-based capital requirement. Under Section 1790D of the Federal Credit Union Act, the board has broad discretion in designing the risk-based standard. In designing such a risk-based standard, Congress did not restrict the type of instruments that the board may include in its calculation of risk-based capital, except that such calculation must take account of material risk that the net worth ratio alone may not protect against. And to conclude on this point, something else I want to just reiterate is that this rule would not allow a non-like you to count subordinated debt as net worth. That is a statutory provision which we are unable to alter.
Justin, thanks. And so the real key here is that it's based on borrowing, which is clearly outlined in the Federal Credit Union Act.
That is correct.
And that what we are proposing is debt that is being, if you will, borrowed from the investor, not an equity investment.
That is correct.
So that is fully permissible under the Act.
Absolutely.
Great. Larry and Tom, Tom, I actually think you spoke a little bit about it in answering the chairman's question earlier about the unintended consequences of this proposal. Would the two of you comment about, could this proposal, if implemented as drafted, lead to large credit unions getting larger? For example, would a complex credit union be able to use the proceeds from the issuance of the subordinated debt to pursue a merger with another financial institution? Jump ball?
I'll start. Yeah, jump ball. I think I'm a little taller.
I completely agree.
But, jumping, I don't know. Yeah, I'll just pick up on my earlier remarks. Yeah. There are two things here. There's a binding constraint, obviously, if you're complex, because obviously you would not be able to count it toward, and non-like you, of course, if you would not be able to count it toward net worth. So there's a binding constraint there that works in our favor. And that's just an economic backstop, if you will, in terms of leveraging up your balance sheet and its potential dilution of net worth. Secondly is, our application process. We spent an enormous amount of time on increasing the transparency of what we're looking for in your strategic plan. And in terms of your budget and your pro forma financial statements on how those funds are going to come into the institution and how you're going to put it to work. So while it may be a prerogative for them to grow, and our whole position on that would be, obviously, is it safe and sound? Is it in accordance with the plan that we've already approved?
And Tom, just to take that a little further, so the binding constraint is the net worth ratio
for non-like you complex,
complex, and the retained earnings that have been built up over time. And correct me if I'm wrong, but in transactions, credit unions generally can only bring retained earnings to the table in making the purchase of, say, of bank assets or other financial institutions' assets. They aren't able to go like others and have use debt instruments or to issue stock. They can only use retained earnings.
Correct.
So it's that retained earnings which is really the binding constraint. I appreciate that. The third question that I have is, in response to the advance notice of proposed rulemaking, several commenters opined that restricting investment in subordinated debt to credit union members would help to preserve the mutual, member-owned structure of credit unions. However, this proposed rule would not only allow institutions to make investments, as currently is the case for secondary capital, but it would also allow accredited investors, including individuals who may not be members of the credit union. Why did staff recommend this expansion, and what safeguards are in place?
So I'll take a shot at that. Just to maybe frame this up a little bit. Currently, low-income designated credit unions can issue secondary capital to institutional investors, regardless of membership. So the institutional investor might be a member, it might not be a member.
Sure.
So the institution-only broad member versus non-member. This proposal expands it from institution-only to also to the broader accredited investor, which includes some natural persons, consumers, investors, but who meet the accredited investor standard set by the SEC. it doesn't change the member versus non-member, which goes back to Justin's point. It's a form of borrowing that's already authorized, and federal credit unions can borrow from any source. So they can borrow from their members. They can also borrow from non-members. And so that's why we're not limiting it to members, but we are including a broader set of the types of investors, the institution plus consumer natural person who's accredited. And that's the universally, well, not necessarily universally, but the broadly accepted standard for more sophisticated investors, the accredited investor standard, and we're pointing to the SEC rules on that. In fact, Justin, I think there's you might want to elaborate a little bit on that.
Sure, be happy to. So just as a general matter, while the definition of accredited investor is quite granular, and I'm not going to walk through each and every provision, the general definition is that a natural person who has more than $1 million in net worth, or who makes more than $200,000 in income per year.
And just before you go on, that $1 million in net worth is outside of their housing assets, correct?
Correct. And it also includes organizations with $5 million or more in assets, and certain other types of entities, provided that they meet certain restrictions. And to Larry's point, in December of 2019, the SEC recently proposed a rule that would amend the definition of accredited investor to include several new categories. So as we go through the comment period, we'll be watching that closely and seeing what the SEC does with that proposal.
You actually anticipated my second part of the question, and I have long been concerned about accredited investors. It's somehow deemed that wealth is a proxy for sophistication. And the fact is that we have people who have had $1 million investments, or they have had $1 million loans, who haven't necessarily had the full consumer disclosures that are made to them, which is really important here, why we make sure that the disclosures are sufficiently clear. My fourth line of questioning is that, as the proposed rule making notes, quote, the decision to offer and sell securities like subordinated debt should be made only after careful consideration, preparation, and diligence by the issuing credit union, including with professional advisors as warranted. I know that you briefly covered this point in your presentation, and Tom, you were talking about it earlier in your answer to the chairman, but for emphasis, would you highlight again why the use of professional advisors is so important?
Sure.
You're going to do that? Okay.
I'm happy to answer that question. Well, this proposed rule is comprehensive and voluminous. This rule sets forth minimum standards for the Ncua. It is not in any way intended to be a guarantee that compliance with our rule will ensure compliance with any and all securities law. As we've spoken about with the Ncua's own resources, securities law is a very complex area, and it is ever changing.
Sure.
And this is why it is so important and so incumbent upon a credit union to consult with industry experts in this area to make sure that they are complying not only with our rule, but with the broader anti-fraud and securities laws that are out there that will be facing them as they issue subordinated debt.
Thank you for that answer. And my final question is a technical question, which I think Tom or Julie, you may want to answer. Under this proposed rule, subordinated debt must have a stated maturity of 5 to 20 years at the time of issuance. Would this limitation prevent the renewal of the subordinated debt at the end of the maturity period?
So I think the key, obviously, yes, you're correct. The proposal requires a minimum of 5 years and a maximum of 20 years.
Sure.
And so the key, the way we reflected in the rule is, and I'll use two terms, fixed stated maturity.
Mm-hmm.
And so what that means is the transaction almost resembles a bullet-like transaction with no renewable features inside that. So short answer, yes, it would be prohibited. Obviously, at a transaction at its maturity, they don't need approval for that. But if they're going to come in and want to renew that, or at least re-up for a new note, then they have to come in and get approval.
And Tom, just going a little deeper on this point, my understanding is that some low-income credit unions have used subordinated debt, certainly to expand their membership. And some of that subordinated debt has come from banks who are seeking credits under the Community Reinvestment Act. And the bank may make the decision at that point in time that it wants to, if you will, re-up, but it has to go through a reapproval process. Is that what you're
The issuing credit
saying?
union, yes, would.
And Tom, could also the economics of the transaction change over time so that at the end of the maturity period, things aren't the way they were?
Absolutely. Obviously, market forces around interest rates and credit spreads and the ability of the credit union to market itself to investors would be significant factors.
So does that make it important for credit unions who decide that they want to pursue the subordinated debt level to have a plan to get out of it in case those market forces turn against them at that maturity point?
And that's primarily why it's a key component of our requirements. Demonstrate to us that you're safe and sound, you have the capital, you have the supervisory controls in place, and what you're going to do with those proceeds.
In sum, this proposed rule is an important one for us to consider and seek input on. If implemented as proposed, the rule would affect 55% of all credit unions holding 90% of the total assets of the system. This proposed rule, therefore, has the potential to transform the credit union industry over the long term. As such, I hope that we will receive robust responses from a broad array of stakeholders and interested parties during the 120-day comment period. And I do agree with you, Mr. Chairman, as well as with NASCUS about the importance. It took us several years to develop this rule. The least we can do is to offer 120 days to our counterparts in the states to take a look at this as well as the entire industry.
Thank you. Board Member McWaters.
Thank you, Mr. Chairman. In a legal career approaching 40 years, I've witnessed a number of financial crises. Although credit unions and the Ncua were not involved in each of these events, it is nevertheless important for credit unions and their regulators to appreciate the common denominators underlying this disparate array of financial disasters that created widespread economic pain, and with respect to the financial crisis of 2008-2009, the most severe economic downturn since the Great Depression. Each of these events was caused in substantial part by the overconcentration of banking and other financial assets in narrowly circumscribed areas of lending and investment activities such as commercial and residential real estate. Simply put, the banking and financial community stuffed too many eggs in one basket and then proceeded to drop the basket with the expected result. Unfortunately, Main Street consumers took the brunt of the financial pain, while Wall Street banks and related participants often escaped under the rubric of too big to fail. Regardless of the overconcentration of financial resources and the resulting asset bubbles, the adverse economic consequences arising from these events would have been substantially mitigated if the relevant financial institutions had held sufficient levels of regulatory liquidity and capital. Although I am confident that financial regulators have identified and appropriately addressed many nascent asset bubbles and other emerging issues, the vexing question remains as to what safety net exists if these regulators fail to address acute market aberrations in a timely manner. After all, at the time of excess, the economy is often booming, and market participants want the profitable financial activity to continue unabated. As history regrettably indicates, it is occasionally challenging for financial regulators to appreciate when a financial bubble is developing and yet another well-touted business model is beginning to fray in a stealthy manner. At such time, naysaying yet insightful regulators are often chided as not getting it or being old school in their thinking. With these reflections and perspectives as guidance, both the regulators and the regulated must at all times remain mindful that in a financial crisis or economic downturn, the fate of a financial institution depends upon its levels of liquidity and capital. At the height of a financial crisis, when asset values have fallen or collapsed precipitously, nothing matters more than liquidity or the ability of a financial institution to pay its debts and other obligations as they come due. In tandem with the role of liquidity, capital serves as a buffer to absorb the losses booked from declining asset values that inevitably follow an economic downturn and the often dramatic and unexpected end of myopic financial activity in a bursting asset bubble. As bedrock philosophy, prudent regulators operate with two fundamental mantras. More liquidity is better than less liquidity, and more capital is better than less capital. Regarding the latter, however, under the Federal Credit Union Act, credit union authority to raise capital for both the risk-based net worth ratio and the net worth ratio test is materially limited. First, under the Federal Credit Union Act, credit unions are limited to issuing debt as opposed to equity instruments. Stated another way, the Federal Credit Union Act does not authorize credit unions to issue equity capital in a private placement or a public offering. Second, even where under the Federal Credit Union Act there is authority to issue debt, the permissibility of counting the debt towards the risk-based net worth ratio or the net worth ratio is statutorily limited to complex credit unions, low-income credit unions, and new credit unions. Under current Ncua regulation, non-low-income credit unions may only build regulatory capital through the retention of earnings. As a safety and soundness prudential regulator, these limitations present formidable challenges to the Ncua that are not faced by the other financial institution regulators. Banks, by contrast with credit unions, may issue both debt and equity securities in public offerings and private placements for regulatory capital purposes, and community banks may often avoid corporate level income taxation by making a taxpayer subsidized S corporation election under the Internal Revenue Code. In order to address the safety and soundness issues arising from the fundamental importance of credit union regulatory capital in a financial crisis or economic downturn, the board today is presented with a proposed subordinated debt rule, the primary purpose of which is to permit non-low-income credit unions to raise regulatory capital for purposes of the risk-based net worth ratio test in full compliance with the Federal Credit Union Act. In addition, consistent with the Federal Credit Union Act, the proposed rule does not permit non-low-income credit unions to raise regulatory capital for the net worth ratio. While the proposed subordinated debt rule offers credit unions enhanced regulatory flexibility, it is not without meaningful limitations. Subordinated debt, by definition, represents non-equity capital that is deeply subordinated to the other obligations of the issuing credit union. In contrast with common stock that is issued by money center, regional, and community banks to their shareholders, the instruments governing subordinated debt must obligate the issuer to pay interest and principal pursuant to contractual terms that may also include affirmative, negative financial covenants, representations of warranties, events of default, and remedial and indemnification, among other rigorous exacting provisions. The issuance of subordinated debt will also require the investment of management time, as well as the employment of legal, accounting, financial, and investment banking resources. Although subordinated debt is expensive and not easy to issue and maintain, its use may offer interested credit unions in full compliance with the Federal Credit Union Act with the ability to, 1, enhance their lending and other member-oriented activity, 2, better assist the unserved, underserved, and those of modest means, 3, build their fields of membership, and 4, enrich their community service activity, while also supplementing their regulatory capital. If prudently underwritten and managed, subordinated debt will serve as a partial safety net from the adverse economic consequences that will inevitably follow from future asset bubbles, economic downturns, and poor lending and investment practices. Even though credit unions did not cause the Great Recession of 2008-2009 and the resulting taxpayer-subsidized bailout of Wall Street and the banking industry under the TARP program, both credit unions and this agency should remain mindful of the strict statutory limitations placed on the ability of credit unions to raise regulatory capital for safety and soundness purposes. It is long overdue that the Ncua propose a subordinated debt rule that will afford non-low-income credit unions with the ability to supplement the regulatory capital in strict compliance with the Federal Credit Union Act. After all, from a safety and soundness perspective, more capital is better than less capital. The decision to issue subordinated debt will ultimately reside with each individual credit union's analysis of how the proceeds generated from the issuance will fit into its specifically tailored business model. While some credit unions will refrain from issuing subordinated debt, others will consider it in the best economic interest of their institution and members to do so. In the final analysis, it's entirely a business decision, provided the issuing credit union complies with the final regulations adopted by the board, and the issuance of the subordinated debt does not create a safety and soundness or consumer protection issue. The proposed subordinated debt regulations are complex with a relatively steep learning curve for those who are not well versed in the issuance of debt instruments in compliance with securities law. It is critical that members of the credit union community and other interested parties review the proposed rule and offer comment. While our principal objective is to ensure the safety and soundness of the National Credit Union Share Insurance Fund and the credit union system itself, we are also keenly interested in better understanding the market viability and economic feasibility of subordinated debt instruments issued under the proposed regulations. We welcome and anticipate a rigorous amount of comments. As a safety and soundness prudential regulator, I've advocated on behalf of a subordinated debt rule since joining the Ncua board in 2014. As such, I wish to express my gratitude to those former Ncua board members and others within and outside the credit union community who have enthusiastically supported the ability of credit unions to employ subordinated debt. In closing, I also wish to thank the Ncua staff for their prodigious and tireless efforts in drafting and vetting these proposed rules in a thoughtful and transparent manner. If approved today, please appreciate that this undertaking represents a work in progress with much time and effort remaining. Thank you. Mr. Chairman, I have no questions.
Thank you, Board Member McWaters. I would like to personally thank you for your leadership and steadfast determination to bring this proposed rule to the finish line as we've seen it today. This is something you have advocated for quite some time, and to know that this has been in the making for 6 years now says a lot. Delighted that it came to fruition, but it was your leadership and enthusiasm for it that got us here today. So I would like to publicly thank and applaud you.
Absolutely. And Rodney, I could not agree with you more. Mark, you have done a fantastic job on this over the years. You certainly shepherded this issue. You highlighted this issue. I can remember sitting when the board was originally considering risk-based capital rules, and you talked about the importance of this. And we would not be here today, but for one, your leadership, but also two, your insights into securities law. That's been a really valuable viewpoint for us to bring to the table. And I also want to thank and applaud you. So.
Great.
Well, thank you, gentlemen. I really appreciate that. But see, the thing is, with a three-person board, you have to be able to count to two. And I'm only one person. So if these two gentlemen do not vote for this, well, you know, it's been fun. But thank you.
Very well. Very well. With that being said, is there a motion?
There is indeed. I move that the board approve parts 701, 702, 709, and 741 of the Ncua rules and regulations for a 120-day comment period as attached to the board action memorandum.
Is there a second?
I will second it, so you will get to that second vote.
There is a sufficient second. All in favor say aye.
Aye.
All opposed, nay. The ayes have it, and let the record show the motion passed 3-0. Thank you all. The last item on our agenda today is the Federal Credit Union Loan Interest Rate Ceiling. Staff presenting Owen Cole, Associate Director, and Tom Fay, Director of Capital Markets, Office of Examination and Insurance. And gentlemen, I see some of you are standing. I know we're now approaching the 2-hour mark. There are some seats maybe in the back. I think there is one up front, but I recognize that you all have been almost standing with us for about 2 hours. So and there are some other seats on the other side as well, if you would like a seat. Very well, just making sure you guys are all right. Well, welcome, gentlemen.
Thank you. And good afternoon, gentlemen.
Good afternoon.
We are here to request the board's approval to extend the existing temporary maximum 18% interest rate ceiling on loans made by federal credit unions for the period of March 11th, 2020 through September the 10th of 2021. The proposed extension is an 18-month period, which is the maximum time allowed by statute. Absent a board action before March the 11th, the loan rate ceiling will revert to the statutory maximum rate of 15. If the loan rate ceiling reverts to 15%, the maximum permissible interest rate for payday alternative loans, known as PALs, will also become 15%. Congress initially established a statutory 12% loan interest rate ceiling for federal credit unions in 1934. In March of 1980, through the Monetary Control Act, Congress raised the interest rate ceiling to 15%, and importantly, authorized further increases at Ncua board discretion for periods not to exceed 18 months. Hence, the temporary nature of the Ncua board established maximum loan rate. Under the Act, if the board seeks to set a temporary higher maximum loan rate more than 15%, it must first determine that two criteria are met. One, a determination that money market interest rates have risen over the preceding 6 months. And two, a determination that not approving a higher interest rate would potentially threaten safety and soundness of individual credit unions, as evidenced by adverse trends in growth, liquidity, capital, and earnings. So as outlined in our board action memorandum, we submit that the statutory criteria have been met to authorize a rate above 15%, and we do recommend the loan rate ceiling be maintained at 18. This level provides sufficient room for federal credit unions to appropriately and competitively risk price certain unsecured loan products, and notably, it allows for a continuation of the payday alternative loan program. As our supporting analysis indicates, a significant portion of federal credit union, including many low-income designated credit unions, are making unsecured and payday alternative loans at rates above 15%. And these loans are an important source of affordable credit for many lower-income members. These loans are also an important segment of the portfolio for a significant number of our federal institutions. And while this recommendation would allow the temporary rate to stand for a new 18-month period, the board has the option to review and change, if necessary, the interest rate ceiling at any time before that period ends. Thus, you can choose to redeliberate the rate ceiling prior to this proposed expiration, which, as I mentioned, will be in September of 2021. And for our part, staff does continuously monitor trends in credit unions and the levels of market interest rates, and we will alert the board to changing conditions which may warrant a redeliberation of that maximum loan rate sooner than 18 months as warranted. That concludes our prepared remarks. We'd be happy to answer any questions.
Great, thank you. Establishing a temporary higher maximum loan rate for federal credit unions can to many of us seem counterintuitive, but it's quite necessary. A significant number of our credit unions depend on this temporary ceiling because it gives them headroom above the statutory rate to effectively expand the qualifying universe of low-income members to whom they can lend. I am pleased that credit unions are effectively using sensible risk-based pricing as a means to achieve a more efficient allocation of their capital. This is truly important because it also allows them to support more lending risk responsibly, while better optimizing the extension of credit across their memberships. In other words, this allows many of our federal credit unions to extend more credit than they would otherwise do if no temporary increase in the ceiling were granted. It's interesting to note that today we're contemplating a renewal of the temporary maximum loan rate of 18%, a rate that has been sustained continuously by the Ncua board action since 1987. And we do so now again at a time when lawmakers in various parts of the country are proposing laws to establish maximum loan rates on consumers at levels as high as 36%. So, when you say that the 18% rate is allowing sufficient room for responsible pricing, we are still authorizing a ceiling far below what many contemporary policymakers view as a prudential rate cap. I am comfortable with the proposed rate, and I will be supporting it today. I also would like to note that I know that previously the Ncua board issued its regulatory reform agenda, which included plans to issue an advance notice of proposed rulemaking to seek stakeholder input on the concept of using a variable rate when setting these temporary rate ceilings. This initiative was delayed behind other board priorities last year, but I must say that I am open to the idea of getting comments from federal credit unions on this topic. In fact, The board always encourages comments from credit unions on any matters bearing on their service to members where we have the authority and discretion to act. With that, I'd now like to ask a few questions. You mentioned that establishing the temporary higher loan rate ceiling gives credit unions necessary room above the statutory ceiling of 15% to risk price certain unsecured loans appropriately. You also indicated that a significant portion of federal credit unions, including many low-income designated credit unions, are making unsecured and payday alternative loans at rates above 15% already, and these loans are an important source of affordable credit for many low-income members. What kind of growth have we seen in unsecured loans since the last time we set the temporary rate back in September 2018, and how do you believe the higher rate factors into it?
Let Tom answer that.
Thank you, Chairman, for the question. We know that the temporary maximum loan rate plays into unsecured lending. And how do we know that? By virtue of the call reporting, we can see that 68% of federal credit unions today are lending at rates higher than 15%. In fact, the total amount is close to $17 billion. So we know this rate already plays into their unsecured lending planning. To answer your question more specifically on unsecured lending, we know, and also that balance since the last time we set this rate has increased almost 8% in total. So unsecured lending, including credit cards, other unsecured lending, student loans, and payday loans. So we know that's increased almost 8% since the last time we set this rate, which has actually outpaced all of lending growth, which was only at 5%. So we're seeing a higher lending, unsecured lending balances. We're seeing more over 15%. So with that, we believe that this temporary maximum loan rate is a net positive for federal credit unions.
Great, thank you. And could you clarify one of the items that we discussed in our briefing? There are many, when I'm out speaking at different events, that can sometimes confuse this rate with the military lending rate, the 36%. There are those that often, I don't know if that's something that any of you can maybe discuss the difference.
This is something unique to federal credit unions because, and as I mentioned before, we have always had a ceiling, a maximum loan rate that could be charged, and forever it was 12%. And it wasn't until we experienced dramatically hyperinflation in the 70s and unprecedented high levels of rates for deposits and the cost of credit that Congress took the action to put in sort of a safety valve for us. But you're right, there are other initiatives right now in state legislatures, and I think also some bills in Congress, where they're looking to establish a prudential ceiling at 36%. I don't know what's magic about 36%, but it is the number I think that it is currently being contemplated for some of those, and actions have already been taken to protect the service members from predacious lending practices and usury. And so we're said another way, we're setting a level at half of what they regard to be sort of a usury ceiling.
Which is why I wanted to amplify it this morning. So thank you. I have no further questions. Board Member Harper.
I have no questions.
Board Member McWaters.
I have no questions, although I would like to say that I really welcome the presence of the New York Taxi Workers Alliance. You know, I know you came a long way, but this is, I think, democracy in action. You have something to say, come here and say it in an open meeting. I appreciate that very much. I would also welcome the opportunity to hear from you if you have something to say specifically. I can't comment on what the agency is doing with respect to medallion loans, but I would like to hear your perspective. You know, if we stay in this building and we have one view, sometimes we need to get different views. Well, we are getting different views in this, but as far as I know, we haven't reached out to you guys and heard what you have to say. And I want to know. I can't speak from other board members, but I'll bet you anything they would also like to hear what you have to say in working this into the matrix. So thank you.
Thank you. And back to the agenda item. Is there a motion?
I move that the board approve maintaining the current temporary 18% interest rate ceiling for loans made by federal credit unions through September 10, 2021, as detailed in the board action memorandum.
And is there a second to the motion?
Second.
There is a sufficient second. All in favor say aye.
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 All opposed say nay. The ayes have it, and let the record show that the motion passed 3-0. And before we adjourn, I too would like to welcome our guest today from the New York Taxi Workers Alliance. You all are welcome to stand. Let us stand. I typically welcome y'all at the beginning. You're welcome to stand and let us recognize you all today for joining us. Please do stand. We would like to recognize you that you're here. Here. Thank you. You have all honored us all with your presence. You've honored our meeting proceedings today with your presence today. So I certainly am delighted that you're able to join us. Please know that NCUA is making every effort when we can to work to provide individual loan modifications and working with the borrowers while also maintaining the strength of our National Credit Union Share Insurance Fund. As I've mentioned in some of my recent congressional testimony, I recognize that behind every loan that's been made is a family behind it. I recognize that also you all, when I'm in your city, when I get to ride with many of the drivers, in fact, maybe I've ridden with some of you, where when I see the pictures of your families in the taxis, when I ask about them. So again, recognize that the decisions that we make, there are others that are involved in those being those family members. So thank you for joining us. We welcome you here. And as Board Member Waters said, we all want to take opportunities to hear directly from you. So thank you for joining us. And with there being no other business to discuss, we are hereby adjourned.